Think Realty Nation, it's your host, Abhi Golhar. Welcome to the Think Realty podcast. In this show, you're going to learn everything you need to know about IRA investing and what it means to set up an IRA and what you can really do with it. And what I love, and I'm looking over my show notes, one of the things that I've been a huge proponent of is a Roth IRA. And a Roth IRA, if you don't know, is a tax-free investment vehicle, but if you couple it in a self-directed format, you can really win the money game. And we're going to talk about that with my guest, Clay Malcolm from Advanta IRA, based right here. He's based right here in Atlanta, and I'm excited to have the conversation with him. And then after we're finished with him and that education, we're going to jump right into how to not let the new normal slow you down, and that's inspired by an article that Bruce McNillage wrote for the Think Realty blog. So excited to have the show today. This podcast is brought to you by Nevada Real Estate Investments, your premier source for cash flow investment property. Visit www.turnkeyrealestateinvestments.com. All right, let's get started. A lot of good information. Clay, welcome, man. I'm excited to have the conversation with you. Let's go. Tell us a little bit about Advanta, who you are and what you do.
Great. Yeah, Advanta IRA is a self-directed IRA provider, which means essentially we're an IRA custodian that can handle alternative assets. So if you want to have your IRA, whether it's a traditional or a Roth, even an HSA, a SEPA or simple IRA, any of those account types, if you want to have them invest in quote unquote alternatives, such as real estate, you needed a custodian that knows how to handle those assets, and that's what we do. So we provide the account and the bookkeeping and administration for them, and that allows you as the account holder to have your tax advantage money invested in real estate assets.
So from a long-term perspective, if I'm a real estate lender, if I'm somebody that's thinking about rolling some money over, why is a self-directed, the way of a self-directed IRA, why does that make more sense than like just going to a Vanguard or insert your favorite bank, I guess, here, and investing in a real estate ETF, for example?
Sure. Well, I think the biggest advantage of a self-directed IRA that handles alternative assets is that you can bring your own expertise and the expertise of your financial team with you. So one of the things I typically like to let people know is that if you know how to make money outside of your IRA, more often than not, you can actually make money the same way within your IRA as long as you take the time to set it up. So if you have an expertise in real estate or lending or something like that, then you can actually take that expertise and put it to work to have your tax advantaged account grow. The other thing I think that is really important, especially in this financial time, is your ability to diversify into different asset classes and to adjust to economic conditions. Banks and brokerage houses who offer IRAs certainly offer some diversification, but it's generally speaking limited to things that are publicly traded securities.
Yeah.
So that is a bit limited. Whereas with an IRA with us, you could actually own physical precious metals, physical real estate, make loans, invest in private companies, things like that. So your ability to adjust to the market conditions is really enhanced.
Yeah. And what's interesting too is if I wanted to, and for those that are listening, you're like, wait a minute, I can do a lot more. And what Clay is telling me is I can be a lot more flexible with where I put my money. And that's exactly what the point is here. You have control over your money, and nobody else should care more about your money than you. And in my experience, like I have real estate ETFs, I have healthcare ETFs in my portfolio with Vanguard, but I also have a self-directed IRA that is out there generating cash flow, and especially if you do it right, it could be a really good strategy for you. So Clay, let's jump into some of your favorite real estate IRA strategies, because I know you have a bunch of them. Let's talk about the top three. Which one's your favorite?
Well, the one I think that gets my blood flowing the best is really the Roth IRA that owns a rental property. And generally speaking, that's going to be a single family rental, but it doesn't have to be. But the idea behind a Roth, of course, is that you make your contributions post-tax. And as long as you keep that account open for at least 5 years and you take distribution after 59 and a half, all your distributions are tax-free. So you actually take away the worry about whether income tax rates are going to go up or where your tax situation is going to be when you start taking distributions. And so when you couple that with an asset that is producing rental returns, you actually create the ability for you to have income that's tax-free. So for instance, my Roth IRA goes out and it buys a rental house. Even if I use debt to buy it at the beginning, if I've paid off the debt at some point along the way, and I turn 59 and a half and I want to start taking distributions, every month that property is rented, it's generating that rental income, and I can actually turn around and take that as a tax-free distribution, whether it's monthly or quarterly or whatever it is. But I've literally created tax-free income for myself that could go virtually forever as long as the property keeps operating and the rental returns keep going. Obviously I need to look out for maintenance and all those types of things on a long-term basis, but good heavens, to have an income that really you don't even have to worry about what the tax event is and have it just be repeating over and over again. It just seems like one of the really excellent applications of this tool. And all of these tax advantaged accounts, they're really just tax tools, but using them and thinking about what type of income you want, when you want that income, and what the tax burden or lack of tax burden should be. Putting all those things together in this particular scenario just makes so much sense to me.
So something interesting that you said was, as long as you maintain the property. And I want to talk about that for a second, because this is not just let's say you're cash flowing, you're 59 and a half, you're taking distributions, and from the distributions, you're now renovating or maintaining the home. The IRA still has to pay for the maintenance of that home, right? Or can I do that personally? I just want to make sure there's a clear delineation there, because I don't want folks that are thinking, well, geez, hey, it's a distribution, it's great, woo, it's money. And you know what I mean? So can you help me understand the logistics of how that works? I don't want to get in trouble if I'm going to set this up. You know what I mean?
Sure.
Yeah.
Well, the IRA is your IRA is actually a separate legal and financial entity from you, and it would be the owner of that property. And so it does need to take care of all the things that any property owner would. So taxes, insurance, maintenance, all those types of things. So that's really part of how you calculate the cash flow. So yes, if you have rental income coming in, you may need to keep a little bit in reserve just in case there's an emergency at the rental house or the rental property, whatever that is, and things like that. So you need to manage it like you would other rentals that are producing income for you. That part doesn't change. The part that's cool that changes is that you don't pay any tax on the income that's coming into you. But keeping in mind your property management style and structure and planning, that's an important part of it.
Let's talk about partner accounts for a second. We talk about HSA. How can I benefit from an HSA with a self-directed IRA? I've never heard of that before, and that's kind of an interesting concept as well for a lot of folks that are tuning in. Can you help me maybe dig into that a little bit, explain why that's a good thing for me?
Absolutely. And I chose HSAs because typically speaking, they have a little bit less cash value at this point. The annual contributions are a little bit lower perhaps than your IRA and things like that. So usually when people have a health savings account, an HSA, the cash balance is a little bit lower. But a low cash balance is really the idea that I had. It's one of my favorite strategies, and the strategy is that if you have several accounts or several pots of money, so to speak, that are investable, some of it could even be your personal funds, to take your tax advantaged account that maybe has a low cash value and make it a partner in a particular asset. And so I'll just give you an example. And just because I know HSAs are a little bit new for a lot of people, do remember that a health savings account, unlike a flex spending account, is an ongoing individual custodial account. It actually operates almost exactly like your IRA does in terms of its investment rules and things like that. So it's not use it or lose it. So it can be a participant in an ongoing investment. And so one of the scenarios that occurs to me that I've seen quite frequently lately, especially as HSAs have gained popularity, is that, let's say my traditional IRA has plenty of money in it to buy a rental house, but my HSA has just a very small cash balance. Well, I can actually have those two accounts, both of mine, my traditional and my HSA, be tenants in common owning a property. And therefore, both of those accounts get the benefit of the returns on that investment. So just because my HSA didn't have the entire amount to buy a property or to participate in a particular investment doesn't mean that it has to sit idle. I can actually use it in connection with my traditional or my Roth or even my personal finances in some cases to have it take the benefit and accrue the growth that is associated with the investment type. So having that ability to create partnerships and have lower cash value accounts make some money,
Yeah.
it's a really exciting strategy. And I've seen people do it with a lot of great effect.
So I was looking over at my producer, Dave, because I'm like, dude, I haven't heard of this like at all. And I think I'm just like smiling from ear to ear. I'm like, this is such a crazy strategy. I'm like, this is nuts. So you're telling me that my self-directed HSA can be a tenants in common with my self-directed Roth IRA, and my HSA, the amount that's in my HSA obviously is going to go to my healthcare spending, obviously.
Yes.
I can't just like withdraw that willy-nilly and go, put it toward like a down payment of a car that I want. That's
Correct.
holy cow. Okay.
And if you think about the HSA's tax benefits,
Yeah.
contributions are pre-tax, like a traditional IRA. The earnings are tax deferred. And assuming that you make a distribution that corresponds to a qualified medical expense, it's also tax-free on the way out. So you're actually, the earnings in your HSA, you might never pay taxes on any of it. I mean, it's almost free money. It's as close to free money as you're probably going to get.
So question for you, how much can I contribute to my HSA? Because now I'm thinking, right? Like, now I'm like, okay, well, I've got a self-directed IRA, right? I'm taking all the advantages of the education with AdvantaIRA.com. And I'm like, wait a minute, if I can contribute as much as I can, so what's the contribution limit to a Roth IRA? It's like $6,000 a year, right, for an individual that's not of retirement age, and then I can accelerate that an extra $1,000, I think.
After age 50, so 6,000 if you're under 50, and 7,000 if you're over 50.
Perfect. So I'm 35. I can invest $6,000 a year after year after year. I'm taking advantage fully of my Roth IRA contribution. My HSA contribution, is there a contribution limit? Is there a cap on that?
There is, and it depends on whether you have insurance just for yourself as an individual or whether you have family insurance.
Okay.
So at the moment, and it's been changing every year, so I'll give you a rougher estimate rather than a dollar figure. So it's roughly between $3,000 and $4,000 a year for if you have individual coverage, and a little over $7,000 or $7,000-ish if you have family coverage. And again, it's been going up $50 to $100 a year in terms of annual contribution limit over the last several years. I don't know whether that will continue, but it certainly has been going on. And so that is an additional tax-advantaged account where you can shelter money and also create, in this case, tax-free earnings.
So what qualifies as a qualified medical expense? Because that's the other thing that I wanted to ask you. And I don't know the answer, but where would I go to find out? And what does qualify as that? Because I don't want to not spend it on a qualified medical expense and then be in trouble later and then have to pay taxes on the gains, and that would just suck. You know what I mean?
Well, the ultimate authority on what's a qualified medical expense lies with the IRS. But if you know the term Schedule A expenses, which have always been kind of medical expenses that were recognized by the IRS, it includes those, but it also includes things that are not on that list. The list of things that are qualified medical expenses for HSA is actually very large. So vision, dental, crutches, things like that. So there are a lot of expenses that are even broader than the Schedule A kind of IRS medical expenses. So the idea that you wouldn't be able to find a medical expense that qualified over your lifetime, because again, an HSA, until you take all the distributions, it continues to grow. But almost all of us are going to have medical expenses in the 6 digits at some point in our lifetime. So having that money to spend from your HSA is really a huge advantage.
Clay, you've like blown my mind. Like I am completely speechless. Like there's one more strategy here that I know we should talk about, and we're going to do that right now. But I just, it's holy cow. It's like now I'm going to like start looking for qualified medical expenses. I'm going to go up to Salt Lake, go skiing, blow out my left knee, and say, hey, I tore my ACL and I need this. Hey, I mean, don't do that if you're watching this. Just don't try. Anyway, the next strategy.
We're not recommending that.
Right. No, I know. We're definitely not recommending that. So Clay, the third strategy is tax liens and notes. I'm a huge tax lien believer, but we also talk about checkbook control for tax liens and for notes. Give me a 1 minute overview of this. I've got maybe a question or two, and then we'll tell our viewers exactly kind of where to find more information about how they can set up a self-directed IRA account and get going with you. So give me a quick 1 minute summary of checkbook control, tax liens, and notes.
Right. Well, the idea about this, and this is kind of the third of my exciting and strategies, is just that some of the assets that you want your IRA, or you may want your IRA to invest in, require some financial agility. So if you went to an auction for tax liens, or you made a lot of short-term notes, or you want to make a lot of short-term notes in your IRA, any kind of auction, even if you're going to buy physical real estate in an auction, generally speaking, go to the auction. If you win, you need to have the money there. For a self-directed IRA custodian, in some cases, that requires some pre-planning and a good bit of lead up to that particular auction. So it takes a lot more planning. So one of the tools that you can have in your self-directed IRA that is a very helpful one when it comes to financial agility is something called checkbook control, which is essentially your IRA, instead of owning a bunch of assets directly, it owns 100% share of an LLC, which is also a legal entity. And then that LLC, which is funded with IRA money, goes out into the world and buys and sells and things like that. The checkbook part of it is that the IRA holder names himself the manager of that LLC. And so the net effect of that is that you're actually writing checks on your IRA money. Now, you still have to follow the rules. The rules follow the money. The fact that it's being dispersed and received at an LLC does not change the IRS rules for how you invest. But it does give you that agility and the ability to invest in things that may require a lot of disbursement. So sometimes people whose IRA is doing a project where there's going to be a lot of vendors, so a rehab on a house or an apartment building or something, and they're going to be paying a lot of vendors. Sometimes the checkbook control is very good for that too. So any of those assets where you need some financial speed in terms of disbursements and things like that, a checkbook control might be a strategy that's really helpful for you.
I like this financial agility concept. I think that should be a new blog on AdvantaIRA.com. I think that's good. I'll write a blog and send it over to you. Maybe I can be a guest contributor. But yeah, listen, I've learned a lot, especially about this HSA thing. I'm going to go check it out.
Great.
And if I want to get in touch, learn more about Advanta IRA, how do I do that? How do I start the engagement process and just get signed up?
Sure. The website is really a great education. Our website is really a great educational tool. It has all the paperwork and all the information you could possibly want. It's AdvantaIRA.com. You can actually sign up for an account online. You click a link and you get a nice DocuSign document sent to you, and it's very secure, an easy way to get started. And then obviously it has all of our contact information. Myself and my colleagues are always available to you to ask strategic questions or set up questions about, hey, is this a prohibited transaction? What does the IRS think about this asset class? How should I think about partnering? Those kinds of strategic questions are always welcome, and you can schedule a consultation on the website as well. And please feel free to contact me directly. I'm happy to answer any questions that you may have.
Awesome. That sounds great. Clay, this has been really informative. Thank you so much. And everybody watching, seriously, go to AdvantaIRA.com, get signed up, and really understand this HSA thing. This HSA tenant in common and your, holy cow, and your self-directed IRA thing is just, I'm speechless. I never even thought of that. So Clay, thanks so much. Certainly appreciate it. Our next segment is brought to you by Clint Coons of Anderson Business Advisors, nationally recognized for providing bulletproof asset protection, tax, and business strategy advice to real estate investors. Go to www.getbulletprooftoday.com and receive Clint's book, Asset Protection for Real Estate Investors, for free while supplies last. All right, let's dig into this article. If you want to check it out, go to thinkrealty.com, and it is under the sponsored article section. Don't Let the New Normal Slow You Down, written by our friend Bruce McNillage. So, a lot of real estate investors are taking a little bit of pause and saying, well, I might look to 2021 to maybe start reinvesting, or maybe start taking a look at some flips or some rentals acquisitions or some land acquisitions. Bruce makes a really good point in this article where he says, number one, economic challenges will drive more people to rent, which means that there's a higher demand for SFR, for single-family rentals. So just don't stop buying because you feel a certain way. There's a really, really, really big need because there are a lot of folks that are in financially distressed situations that can't own a home. Their credit is shot because it's an unfortunate result of what's going on right now. And they need to rent, which means that there's a very big opportunity for you to help serve them in the highest and best capacity that you're already doing, which is being an awesome real estate investor. Number two, homes are still a good investment. We're not seeing a crazy decline in home values right now. In fact, there's still higher demand for it. So that's another really good factor to take a look at. Number three, acceleration in the SFR world, single-family rentals, for example, it's still there. If you take a look at even secondary and tertiary markets right now. So here's a really interesting strategy, and maybe tying the two conversations together. Number one, if you were to set up a self-directed IRA account with Advanta IRA, open up a Roth IRA channel, I guess, a Roth IRA, a self-directed Roth IRA account, right? Let's do that. And then you use that account and invested in secondary markets and bought single-family rentals. And now you have tax-free distributions when you cross the threshold. I mean, you're winning. So you take Bruce's article, couple it with what Clay from Advanta IRA is telling you, and I think you're really putting yourself in a win-win situation. So take a look at your secondary markets. Bottom line, take a look at your secondary markets. Take a look at your tertiary markets, which is where all the big guys and big girls are playing right now. Invest in them because there's still really high demand for SFR. And invest in them using a self-directed IRA. I think you would be stupid not to do this. That's the show. All right, here, I'm going to close it out. It's been fun. I learned a lot. I'm still speechless. I've been writing notes this entire time. And yes, when we do switch screens and when Clay is on full screen, I'm sitting here typing away. I got my pen and paper ready. But anyway, this has been fun. Thanks so much for watching. If you want to get in touch, you know how to do it. Go to thinkrealty.com. But we can't do it without our sponsor from Nevada Real Estate Group, Marco Santarelli. Thanks so much, man. I appreciate you making this podcast possible. And it's brought to you by Nevada Real Estate Investments, your premier source for cash flow investment property. Visit www.turnkeyrealestateinvestments.com. Think Realty Nation. Until next time, happy investing.